Okay, so now that the Dow has reached another historic milestone, you're probably wondering what to do with your money, whether you're in your 20s or your 50s or even beyond. So let's get some answers tonight. We have Paul Auslander, he's Director of Financial Planning at Provice Management, and Avni Ramnani, who's Director of Financial Planning and Investment Management at Francis Financial. Good to see you both. Thank you for joining us tonight. Paul,
thank you.
It depends on where you are in your life cycle. We don't have time to go through every decade of your life, but generally speaking, 20s, 30s, 40s, what are you going to do with your money right now, do you think?
The 20-year-old's going to keep more in equities, and the 50-year-old's going to keep less in equities. I mean, that's the general rule of thumb.
It doesn't matter what level the market's at?
I don't think so.
We're at lofty levels right now.
I don't think so. I tell the clients the same thing, whether the Dow's at 13,000, 16,000, or 17,000. It's all about asset allocation. Look at the amount of risk that you're willing to accept. Test that every quarter now as opposed to every year. Make sure that you're comfortable with some amount that you might lose, and then adjust your allocation accordingly.
Let's check in with Avni. Do you agree with that? And if you do, how aggressive should that 20 or 30-something be with their stock investments?
You know, a 20-year-old can be a lot more aggressive. I would go up to 70% to 75% in an equity allocation. And then definitely bonds have to play a role too. So keep the rest of the portfolio in bonds. And as far as what the market's doing right now, really, you have to focus on the long term, especially for a 20-year-old. You're not going to use this money, hopefully, and for the next 35 to 40 years. And for that time frame, you have a lot of ups and downs coming your way. So you have to take your emotions out of the investment process and keep with their asset allocation.
Avni, lately, because of the historically low yields that people are getting from their investments, specifically in bonds, they've forego bonds and go with dividend-paying stocks instead. A wise move? Riskier? What do you think?
I think bonds still need to be in the portfolio. Like I said, if you're not going to use this for the next 40 years, there's going to be ups and downs in the market. Sometimes equities are going to be up, sometimes bonds are going to be up. So each segment has its own role to play, and I would shy away from getting rid of bonds completely and having stocks all in the portfolio.
So let's turn, Paul, to somebody who's in their 50s, or maybe somebody's in retirement or close to retirement. You say that you meet with this group on a regular basis because it's not like being 20-something. What's your advice?
Well, to Bill's point, I think as you get a little bit older, you have to be, excuse me, careful with how much you have in equities. But more importantly, and I live in Florida, we see a lot of this. Retired investors haven't been able to get yields from bonds or from CDs, so they've naturally gone more into equities, more into dividend-paying stocks. That's the group of investor I'm most worried about. I think they've taken more risks than they're really ready to assume, and those are the people that I'm talking to. And to Avni's point, I agree that there should be some money in bonds, but I worry that when interest rates rise, bonds will come down in value. So short-term bonds only, in my view, when you have that asset allocation.
But are you telling this age group that maybe they should take some profits, given the unbelievable run that we've seen in the market?
I think it's a combination of taking profits, but more importantly, adjusting that asset allocation strategy so that there will be more in bonds than in equities. And in those bonds, though, I think it's critical that they be very short-term to anticipate that whenever it happens, that rise in interest rates.
Not to put too fine a point on things because of the time we have allotted to us, but stocks are not all equal. You've got riskier growth stocks, you've got the safer, so to speak, defensive plays.
Yeah.
What about a mixture there?
And again, we discussed dividend-paying stocks, largely large cap stocks most of the time. We like a small cap value tilt. I think that's the growth strategy that's worked best for many years. But having said that, there's safety in the large cap companies.
Some final thoughts from both of you. Avni, let me start with you. We've been talking about the things you should do. What is the key thing that you would advise someone in their 20s, 30s, and 40s not to do? And then we're going to turn to Paul and see what he says.
I think what you shouldn't do is not get carried away by the ups and downs of the market. The emotions play a big part, and you need to really learn how to take those away. I would like to add that emerging markets, and you mentioned before, emerging markets is a segment that especially is very important for 20, 30-year-olds because that's where we're seeing a growth capacity potential in the next 15 to 20 years.
real quickly, the best tip about what not to do, mistakes to avoid?
No knee-jerk reactions. Stick to your plan, adjust where you need to, and fine-tune, but don't do anything dramatic, and don't
For any
panic.
age group, really.
Absolutely.
Take the emotion out. Easier said than done, but very good advice. Thank you both, and have a good holiday weekend.
too.
Thank
Paul
you.
Auslander of Provice Management, Avni Romnani from Francis Financial as well.